So all the buzz, even during the course of yesterday's show, was around oil markets. Yes, oil on a crypto channel. Of course, we do a lot more than crypto, but oil. You may have heard a lot of noise about oil markets since yesterday. Well, that's because Monday, April 20th, a day that will live in infamy, for it was this day that the price per barrel for the upcoming futures contract on West Texas crude went below zero for the first time ever. And it wasn't just the WTI crude going negative. May futures contracts on Canadian Western Select crude tumbled below zero as well yesterday. In fact, about 2 p.m. Eastern Standard Time yesterday, April 20th, the futures price on US crude fell below zero for the first time in history. And a little over an hour later, the price dipped as low as negative $38.08 per barrel. So everyone is curious. How did this happen? How can prices on oil go negative? Well, to understand that, we really have to start with understanding the macroeconomic conditions that go into this equation. The world economy has seriously slowed in the wake of the COVID pandemic. Amidst widespread lockdowns and restricted travel, demand for oil and all its subsidiaries has dropped dramatically, and falling demand necessitates lower prices. And let's not forget that the supply war has been raging with major oil producers, Russia and Saudi Arabia, in recent weeks. That's been a major catalyst for sending crude tumbling this year. As we talked about last week, the OPEC and OPEC Plus meeting ended with Russia and Saudi Arabia essentially going back to their countries and ramping up production instead of ramping down. Now, of course, they're angling for a greater market share and long-term prospects coming out of this pandemic environment. But in the short term, in the case of the May 2020 futures contract on crude, we have to ask, why are prices dipping to below negative? It comes down to the issue of who holds the contract when it expires today, April 21st, 2020. Because oil futures are physically delivered, the oil futures trader who happens to be holding this contract by that time has to either take physical delivery of the oil or find someone, preferably a buyer, willing and able to do so, willing to actually take physical delivery of this product. Now, to take physical delivery for just one contract means picking up and storing 1,000 barrels of oil. That is no small task. Physical delivery often takes place in Cushing, Oklahoma. It's the largest crude oil storage hub in the United States of America and an important junction in the settlement of West Texas crude that's traded on the NYMEX exchange. Now, being designated the official delivery point for U.S. crude means it's the most significant trading hub for crude oil in North America. Now, although Cushing is home to some 300 steel oil storage tanks in the surrounding areas filled with tank farms, most of them are already full up thanks to the COVID shutdown, having already slowed the economy for weeks, and it's only getting fuller now. Indeed, oil reserves across the nation are at capacity. There's nowhere to store the latest crude due to be delivered for May. This means when the price of the May 2020 contract hit around negative $38 per barrel, futures traders left holding the bag on these contracts would have to pay someone else $38 to take the oil contract off their hands, to take the oil off of their hands, because they're not going to be able to facilitate physical delivery. Now, Roger Dewan, who is a London-based analyst from IHS Markit Ltd, launched into a tweet storm yesterday explaining what we can expect from WTI futures going forward into the year of 2020. It was this rollover of the contract and a liquidity crunch that made today's extreme sell-off possible, he says, but it doesn't necessarily represent the actual condition of the futures market. So in other words, don't panic just yet when we're talking about the actual price of crude. But the June oil contract is not out of the woods with Monday's price action telling us that the physical oil markets being settled in Cushing are not in good shape and that national storage is getting very full. And with the June contract price down 15% already, real concerns are, of course, mounting that the stress on the supply will continue and force a lot more oil production and refinery shutdowns during May than the ones that have already been announced. Therefore, Monday's negative prices do reflect a dire situation for oil producers, and the hope rests with demand being rebooted in the middle of May in order to prevent a June contract from a similar calamity. Now, earlier today on CNBC, Kate Richards, the CEO over at the energy-focused Warwick Energy Group, described the market drama yesterday, saying that trading of the May contract that went negative accounted for 7% of all trading volume yesterday, explaining that what happened yesterday was, of course, certain players being long about 108,000 lots of the futures contract. Keep in mind, one lot is 1,000 barrels of oil, and they had not yet closed out their long positions, but finally were forced to close out. And once that time came, They were willing to pay someone to take the contract rather than to get paid for the contract and be stuck taking physical delivery of that crude oil next month. Finally, she warned that the remainder of the futures contracts for 2020 and even into 2021 will likely suffer from being priced too high as of right now. Now, looking at the latest data, the June 2020 futures contracts trading around $16.97, down $3.46 today, about 17%. As for the May contract, it's doing a lot better than yesterday's intraday low, but still actually now trading above zero, right? Let's see. I want to check on that because it's been volatile over the last few. Let's see here. Now, closing at 941, so back in the positive, no longer negative, opened at negative 14, closing currently at $9.44. So no longer negative, up quite a bit from yesterday's lows. Of course, many of us in the cryptocurrency space who for years have kind of suffered at the butt of Bitcoin is too volatile jokes, found some humor in seeing prices on a commodity like oil tumble to below zero with, of course, crypto personality Barry Silbert saying on Twitter, you know, Bitcoin saying I like to move up and down 5% every day for no apparent reason. Oil saying hold my beer. So good stuff. Good times. Now, the question is for a lot of people watching, this has generated, and that's what I like about situations like this, because this obviously generates a lot of interest when people see these big price movements as how they can capitalize on these things in the future. And let's be quite real. You know, one thing you want to ask yourself, right? Do you have any experience with trading commodity futures? Have you ever traded oil futures before? Do you know what the differences in types of crude are? These are things that you probably want to know to trade oil futures. Just might help. But if you want to trade oil futures, I will show you how you can do that. Now, oil futures in the United States, this is for Americans. Oil futures in the United States, futures are going to be traded on the NYMEX exchange, right? So you're going to need to find a broker for oil crude on the Chicago Mercantile Exchange. Now, you can go to cmegroup.com. They've got a tool here to find a broker, because the first thing you're going to need to do is find and locate a broker. I've gone ahead and taken the liberty of putting in what I think most of you guys are going to be sitting at, which is an individual trader investor. You're going to be speculating on futures, and you're going to be located in the United States of America, and you're going to want the English language to be supported. So you've got a lot of options here, but of course, the ones that stick out, they're going to be simple, are going to be obviously TD Ameritrade, E-Trade, and then, of course, the one that's probably the most popular is Interactive Brokers, right? So for the purposes of this, and because I know good things about Interactive Brokers, I'm going to say that that's most likely your best bet in terms of functionality. You also want to make sure that you understand the initial margin that you're going to need to trade these contracts. This means that to trade one lot, that is 1,000 barrels, you are going to require the maintenance margin as a minimum on your account to open up the position. Now, in general, and this is coming from Mr. John Ellers, who I interviewed, because he has experience trading these futures markets. What he said is that what he likes to do is take the initial margin, or the initial margin that you need to open up the position, plus the capital necessary for 10 losing trades. Because it's almost essential if you're trading an automated strategy that you will at one point during the course of a year, if you're trading every single day intraday, that you will have a losing streak of 10 losing trades. So you want to have enough in your bankroll to be able to trade. So assuming, depending on what size lot that you're trading, assuming that a losing trade is, let's say, $500, you need, a $5,000 as well in additional margin. So you need about $10,000, $12,500 to trade the continuous contract in front. Because as we can see, the maintenance margin for that is $7,500 US. As you go further out in the contracts, the maintenance margin goes down, the initial margin goes down. So these are important things to consider, but you are going to need this minimum amount of base capital to begin trading these contracts. And let me again put that into context for you. If you have never traded futures before, when you go onto the futures platform, when you go onto your broker and you put in the number of lots to trade, if you just have this amount of maintenance margin plus the initial margin for the contract, and whatever excess capital that you have to cover losses, you're going to be trading one lot, just one. So you know how on BitMEX and ByBit, you can put in amount of contracts, right? Or quantity of coins on Binance. You're going to be putting one in that box, right? And that's how much that's going to cost you. And then, of course, Interactive Brokers is the broker where you can sign up for that. And again, this is not like crypto. You have to do KYC. You have to put all the information in, but that's how you can get started. Again, please trade these things with caution. Just as we say with trading cryptocurrency, it's highly volatile. And realistically, you are trading against some of the most seasoned and professional market speculators out there when you step into CME futures. So Have your game about you, have your wits about you, do your research, trade safely, do not take excessive risk because they will chew you up and spit you out. So trade safely, a lot of opportunity over there, but also weigh realistically, like what are the odds that, and I don't mean this disparagingly, but if you are a random Joe off the streets who has never traded oil futures before, you're seeing all this volatile price movements, the probability for you to make a mistake and end up losing a lot of money as opposed to making a lot of money against professionals who do this on a day-to-day basis is fairly low, right? What are the like, it's very rare that an opportunity is so glaring that you can just run in off the streets and snatch up a profitable trade. So take that into account. I'm not saying that there's no opportunity there. I'm just saying that it may not be as sweet as it may appear on the outset, right?